Welcome back to the deep dive. Today, we are strapping in for, well, a high-velocity look at a really specific high-stakes corner of global manufacturing. We're talking about Azad Engineering Ltd, AZAD.
Right. They make these incredibly complex mission-critical components. Think aerospace and defense, energy, oil and gas, places where failure just isn't an option.
Exactly. And our mission today, to unpack their latest financials Q2 and the first half of FY26, ending September 30th, 2025. We're working off their board update and investor presentation from November 1st.
And they came out swinging with the headline, didn't they?
They sure did, claiming their highest ever half-yearly and quarterly performance.
Okay.
So that's what we need to dig into. Highest ever. What's fueling that kind of claim in a business where, getting a single part approved can take years?
Yeah, that's the core question, isn't it? Because rapid growth in this kind of tightly controlled space, it's unusual. Those lead times are just so long.
So we need to look past just the big revenue number.
Definitely. Is this growth sustainable, or is it more of maybe a one-off bump? That's what we need to figure out.
All right, let's get into the core numbers then. Starting with the standalone results, first half of the fiscal year, H1 FY26, compared to last year, H1 FY25. What's the story there? Does it back up the highest ever claim?
The story looks pretty robust, especially when you get to profitability. So for H1 FY26, standalone revenue hit Rs $2,771.8 million.
Okay.
Which is, pretty impressive. That's a 32.1% increase year over year.
Wow, okay. 32%. In this sector, that is accelerating fast, isn't it? Especially with components needing, 3 years sometimes to get certified?
Exactly. But here's where it gets, really interesting. Their profit after tax, PAT, it didn't just grow by 32%. PAT jumped significantly. Artis, $629.9 million. That's a 64.9% increase year over year.
Hold on a sec. 64.9%. That's almost double the rate of revenue growth.
It is.
That really points towards operational leverage, doesn't it? How are they managing that kind of spread?
Well, it strongly suggests that their massive fixed cost base, all the factories, the specialized machinery, the depreciation, it's finally getting absorbed much more efficiently by this surging volume.
Right.
So basically, every extra component they sell carries less of that overhead burden per unit. It's that classic advantage you see in high-margin, high fixed cost businesses once they really hit their stride with scale.
And crucially, they didn't sacrifice margins to get there.
Nope, they held the line. Their reported EBITDA margin for H1 FY26 was rock solid at 36.0%.
36%. That's very healthy for manufacturing. Shows they've still got pricing power even while ramping up volume.
Absolutely.
And if we zoom into just the last quarter, Q2 FY26, does that show the momentum continuing?
It does. It confirms they weren't slowing down into the second half. Q2 standalone revenue was Rs $1,426.7 million, up 28.1% year over year.
Still strong.
And the PAT Rs $330.0 million, that's up 56.6% YoY. So again, profit growing much faster than revenue. And I think the key thing from that quarterly view is it confirms that 36.0% EBITDA margin isn't just sustainable. It might actually be sort of the new baseline for them.
Phenomenal headline numbers then. The operational leverage seems real, but like you said, in this business, the headline isn't always the whole story. It's about the contracts underneath.
Exactly.
So let's pivot. Where did this big 32% growth actually come from? Which parts of the business are pulling the weight?
Well, the main engine is still their traditional strength and power generation components. The energy and oil and gas segment brought in the bulk of H1 revenue, about 81.6%.
Okay, the lion's share.
Right. And crucially, that segment grew 35.7%. The company directly attributes that growth to utilizing the extra manufacturing capacity they've been bringing online.
So they built it, and now they're filling it, flipping the switch on that investment and turning it into revenue, mainly from energy parts.
Precisely. But, don't overlook the aerospace and defense side, the A&D segment.
Right, the other key area.
Yeah. It's smaller currently, about 17% of H1 revenue, but it grew by 30.3%.
Still very strong growth.
And that A&D growth is quite interesting because it's mostly coming from new products finally hitting commercial scale. Stuff that's been in qualification with certain customers for a long time. That 30 to 48 month cycle we talked about, finally moving out of testing and into actual production runs.
So the long game in A&D is starting to pay off too.
It seems so.
And it's also just striking how global this company is. Exports were, almost 94% of their H1 revenue?
Yeah, 93.9%. They are genuinely a global supplier, not just an Indian one.
Which is a huge strength.
It is, but it also brings risks, right? Currency swings, global supply chain issues, geopolitics. They're exposed to all of that.
True.
But clearly, the demand for what they make is outweighing those risks right now.
And management sounds pretty confident, too. The chairman and CEO is quoted anticipating even stronger performance in the second half and sticking to that full-year target of, what was it, 25% to 30% top-line growth?
Yeah, they seem very confident. And that confidence, it isn't just talk. It's backed up by some really significant new order wins they announced in Q2.
Okay, let's talk about those,
Yeah.
because that gives visibility, right?
Exactly. Long-term visibility. Two big ones stand out. First, they signed Phase 2 of their long-term contract and price agreement, the LTCPA, with Mitsubishi Heavy Industries. That phase alone is valued at USD 73 million.
73 million just for phase 2. That's a big deal with a major player like Mitsubishi. What does that bring the total contract value up to now?
Well, combined with Phase 1, the total LTCPA value with Mitsubishi is now a pretty hefty USD 156 million,
Wow.
which translates to about INR 13,870 million. So yeah, massive multi-year commitment confirming AZ's critical role in their supply chain.
Huge validation. And they also made a move in the A&D space, didn't they? Something with Safran.
They did, yeah. A Memorandum of Understanding, an MU, with Safran Aircraft Engines. This is for cooperation on critical aircraft rotating engine components.
So not just an order, but a collaboration framework.
Right. It's more strategic. It sets up their first long-term collaboration with Safran, aiming to boost indigenous manufacturing. It's about embedding themselves deeper into that A&D supply chain for the future, locking in potential revenue streams down the line.
Okay, so strong underlying contract momentum too. Let's shift gears again, look under the hood a bit. We saw PAT grow way faster than revenue. How are they actually achieving that efficiency gain? What does the P&L tell us?
Right. Digging into the profit and loss. If you want to see how they're squeezing out more profit, a key line item is consumption expenses, basically the cost of their raw materials and inputs.
Okay.
As a percentage of sales, that expense dropped quite a bit. It went from 14.9% in H1 last year down to 12.3% in H1 this year.
Whoa, hold on. That's a 260 basis point improvement in input costs? That's significant. That explains a good chunk of the margin expansion right there.
Absolutely. And the company's explanation. They cited better price negotiation and development on domestic suppliers as compared to foreign vendors.
So a strategic move towards more local sourcing, maybe giving them better pricing leverage, and possibly cutting down on logistics headaches too.
Seems like it. A successful shift, apparently.
But growth costs money too, right? The P&L must show some expenses going up.
Oh, definitely. You see employee expenses and depreciation both increasing.
Yeah.
That's the cost of scaling up. They mentioned strengthening management, annual pay increases.
Yeah.
And obviously, bringing those new facilities online ramps up depreciation charges.
So spending more now on people and infrastructure to support future growth makes sense.
It's that trade-off, investing for capacity.
And speaking of investment, the cash flow statement, this is where that story really comes into focus, isn't it? Because standalone cash flow from operations, CFO, was actually negative for the first half. Negative Rs, 765.3 million.
Yeah.
How do you square that? High profit, but negative cash from operations.
Well, that apparent contradiction, it's actually a classic sign of a company that's in full-on growth mode. They're prioritizing building capacity and grabbing market share over generating immediate free cash flow.
So profitable on paper, but
Well,
the cash is tied up elsewhere.
Exactly. It's getting plowed into working capital, specifically handling higher trade receivables as sales grow, and, crucially, building up inventory to meet all those new orders they're winning. The change in working capital alone soaked up over Rs 1,530 million.
So they're selling things profitably, but they have to spend cash now to actually make and stock the parts for future deliveries. The cash register rings later, essentially.
That's a good way to put it. And the direct investment in future capacity is just staggering. If you look at the investing activities on the standalone cash flow, purchases of property, plant, and equipment, including what they call capital work in progress, or CWIP, that totaled a negative Rs 3,047.80 million just in H1 FY26.
Good grief. Over 3 billion rupees poured into CapEx in just 6 months. And just to remind listeners, CWP is basically money spent building factories or installing machines that aren't operational yet, right? Not generating revenue.
Exactly. They're literally funding the construction of, potentially several new specialized facilities all at once.
That's
It's like
right.
they're profitable, yes, but they're spending maybe 4 times that profit amount today to build the machines that they expect will print money for years to come.
Which brings us neatly to the final section, the moat and the way forward. Because this kind of aggressive spending only really makes sense if you have a massive, almost unbreachable competitive advantage protecting your market once that capacity comes online.
Absolutely. What defines that moat?
Yeah, what makes their position sustainable?
Well, it really comes down to the nature of what they make.
Mhm.
Highly engineered, complex, and mission and life-critical components. We're talking parts where quality isn't just nice to have, it's fundamental to avoiding, well, catastrophe.
Let's pause on that because it's critical. The investor deck mentions parts needing a 0 parts per million defects requirement. 0. How did the company even guarantee that?
It's an incredible standard. It means for a turbine blade or a critical aircraft engine part, their component has to perform flawlessly for potentially decades, or the consequences are severe. This isn't about selling basic widgets, it's about selling absolute certified reliability. And they state they've delivered over 3 million parts maintaining this standard.
And that level of certified reliability, that is the ultimate business shield, isn't it?
It really is, because achieving and proving that level of quality means that the qualification process for any new supplier or even a new component from an existing supplier takes an incredibly long time. They estimate 30 to 48 months.
2.5 to 4 years just to get approved.
Right. It's lengthy, it's expensive for the customer, and frankly, OEMs are extremely risk-averse. Once they have a supplier like AZD that consistently delivers 0 defects, the cost and risk of switching to someone else is just astronomically high.
That explains why their customer base is likely so sticky.
Precisely. And their customer base includes the major global OEMs, who, between them, control something like 75% of the global gas turbine market. Once you're in with these guys and you perform, you have incredible long-term visibility and revenue security.
Okay, so given that deep moat and the huge investment in capacity, how are they planning to leverage all this going forward? What are the strategies for future growth?
They laid out some clear levers. First, pretty straightforward, gain more wallet share with those existing sticky clients, sell them more stuff.
Makes sense.
Second, take the technology and expertise they already have and apply it to serve new clients, likely in similarly regulated high-stakes industries. Third, they specifically mentioned looking at strategic inorganic acquisitions.
Meaning buying other companies.
Yeah, potentially to get into manufacturing larger components, maybe moving towards more vertically integrated production.
And geographically, are they expanding their footprint?
Yes, definitely. Strategic expansion to be close to their key global OEM customers. That MoU for expansion to Saudi Arabia we mentioned is a prime example of that co-location strategy.
Right.
And finally, product expansion, moving into manufacturing even higher value components, things like parts for advanced gas turbines, steam turbines, even nuclear turbines, and also critical aircraft systems like landing gear components.
Okay, so summing it up, this deep dive seems to confirm really robust growth, both top and bottom line. It's driven by filling up capacity in their core energy segment, and finally seeing those long qualification cycles in A&D bear fruit.
Yeah, and it's all underpinned by locking in those huge strategic long-term deals with giants like Mitsubishi and Safran. It validates their position.
It really confirms they're executing a high-risk, high-reward strategy, doesn't it? Invest massively in capacity and quality, and trust that incredibly deep moat to guarantee the returns over the long haul.
And the jump in profitability shows they're managing the internal side costs. Supply chain effectively, too, while the big contracts show the external validation is there.
But that aggression, that huge CapEx spend, it does introduce a really fascinating risk element for you, the listener, to think about. They are betting big on future execution. That 3 billion plus rupees spent on PPE and CW leading to negative operating cash flow.
It's the necessary price for this kind of rapid expansion in this industry.
It absolutely is.
Yeah.
So here's the final thought for you to consider. We know the qualification periods are long, the barriers to entry are high. That's what makes their contracts so valuable. But how dependent is that projected 25% to 30% future growth trajectory on the flawless and timely commissioning of these brand new multi-billion rupee facilities they're building right now? It feels like a high-stakes race against time, where any significant construction or commissioning delays could directly ripple through to their profit forecasts down the road.
It's a critical dependency, no doubt. Execution is absolutely everything for them now.
A great point to end on. Thanks for joining us for this deep dive into the world of mission-critical engineering. We'll see you next time.